The US market has been dominated by a few mega caps, but it's not the only market with a narrow market leadership. I'm here with our fund analyst, Natalia Wolfstetter, who has looked into this in a recently published study with a specific focus on and concentration in the European equity market.
That's right. Investors know about the incredible run of the so-called Magnificent Seven, but concentration is not purely a US phenomenon. And that can be seen in this chart, which shows the share of the top 5 names for various global equity markets. So the US market, which is displayed here in red, it does stand out, but concentration has been on the rise in other markets as well. And that includes Europe, which is the yellow line, although concentration and the increase in concentration is not nearly as large as in the US.
Looking at the Asian markets, it seems like concentration has been quite extreme there as well.
Yes, and Asian markets, and we're looking here at the Morningstar Asia ex-Japan index, which is shown in blue. They do remind us that the returns of the largest stocks can reverse quite dramatically. So we had a peak in concentration in 2021, and then it dropped off a lot as investors moved out of the Chinese e-commerce names, for example. So I think that's interesting, also given the setbacks we have seen recently, which might be a sign that the huge rally in mega cap tech is coming to an end.
And speaking of tech stocks, these have been the major drivers of concentration, haven't they?
Yes, more generally, concentration has been more pronounced in the growth space, and that's quite dominated by everything tech and AI related. In our study, we have included data up to May 2024, and when looking at Morningstar's US Growth Index, which is depicted in dark red, the share of the top 5 names was more than 40%. So that's just the 5 largest names, and that's compared to merely 12% for the value index, which is the lighter red line. So that is massive, but concentration is down a bit since then, and it's also lower in Europe, as shown in the dark and light blue lines for the European growth and value indexes. But again, the growth space is most concentrated. However, in Europe, the largest names are more diversified sector-wise, so they are not only coming from the tech and the communication sectors. Tech is well represented. Think about ASML or SAP. But healthcare as well. For example, there's Novo Nordisk and AstraZeneca. There are consumer names such as LVMH. There are energy and financials names among the largest stocks there.
If markets are so concentrated, what does that mean for active funds?
We find in our study that when indexes are concentrated, the market leadership is really narrow, active funds have to be concentrated as well to have a chance to outperform. Still, active funds have struggled to do so in recent years, and that's because they are not necessarily concentrated in the largest index names, and they also tend to reach further down the market cap ladder. So, for example, this table shows a fund's average positioning in the top index names, and that's for the Europe Large Cap Growth category, and that's compared to Morningstar's Europe Growth Index. And while funds were, in fact, overweight in some of the larger names, such as Novo Nordisk, on average, they were underweight in ASML, in S&P or Airbus in the period we're looking at here, which is from January 2023 to May 24. And that explains, of course, some of their underperformance.
So does it make sense to invest in active funds then? And what should investors do about concentration more generally?
Well, concentration does pose some risks, not only when it comes to diversification, but it can indicate stretched valuations and that expectations about future growth may be excessive. So that's the concern currently around the AI-related enthusiasm as well. The experience shows that strong returns do not last forever. Investors can fall out of love with stocks. However, nobody knows when that happens, which is why we think a balanced approach makes sense by investing in active funds that are truly differentiated, and then combining these with passive strategies, which track market cap weighted indexes. And that way, investors can do something about the concentration risk, but they will still participate if the largest stocks continue to rally.
So as always, it makes sense to diversify. Thank you so much for your insights, Natalia. For Morningstar, I'm Antje Schiffler.